Welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us at the market site in Times Square, we have Joe Capitone. He's the Manager Director of World Gold Council USA. We're going to take a look at gold's performance and fund flows and the impact from the Fed rate cut. Joe, it's great to have you with us at market site. We're going to get right into it, talking about gold's performance. Is it driven by the current risk environment? We'll take a look on our first chart.
Sure. Gold's performance is definitely being driven by the current risk environment, but it's not the only thing that's driving its performance, in particular long term. What investors need to remember is that gold has a dual nature. It's a global asset, and it actually performs really well in market stress, or times like we're experiencing now where there are concerns or questions around what's going on in the risk environment. But it also performs long term really well based on economic expansion. So when you think about gold, think about it in this context. You can hold gold in your portfolio as an investment, and that does really well when you're worried about things in the market, when you're worried about risk, and when you want that ballast and that safe haven asset in your portfolio. But don't forget that it does really well as a consumable and an industrial asset. That iPhone that everybody has in their pocket has gold in it. So when you're spending and things are going well, gold actually factors into that. Gold actually performs well. And you can see from our chart, 5, 10, and 20 years, that ultimately gold is on par in terms of its performance with bonds and equities, in some instances outperforming those assets, and in some instances performing comparable. The other thing to highlight, though, is that it always seems to be outperforming broad-based commodities because of that dual nature. Those other commodities don't have it.
All right, let's move on here. The FOMC rate decision, September 19th, we got a 25 basis point cut. Do you think that is going to have an impact on gold? And we're also going to take a look at gold's performance relative to other commodities.
Yes, of course it will. What our data and our information tells us, and you can find this on Gold Hub, our website, it tells us that over the time, a longer period of time, that rate cuts definitely benefit the overall long-term performance of gold. Usually about 12 months for it to play out. So what we're seeing and experiencing with the US rate environment, which is well signaled and well understood in the dovish environment, is that gold is definitely going to be seeing continual benefits from it. But the other factors to remember are twofold. Number one, we're looking at rates around the world, and 70% of developed markets are in negative rate real rate environments, I should say. So when you start thinking about the ownership of gold and what it does provide you in terms of performance, those attributes become even more appealing in an environment where you're paying no own bonds. The other thing that I want to highlight is here on the slides. In an inflationary environment, gold will do well. But in a low inflationary environment, which is where we are today, so we're hovering just below 2%, gold does exceptional. So people want to own commodities as an inflation hedge by general rule. Gold does really well in a low inflationary environment, which is where we are today. And commodities and gold both do well in a higher inflationary environment. So knowing to prepare for inflation in the future, gold will definitely be a component. But when you start thinking about it in the context of the low inflation environment, it outperforms. Does really well.
Do you think investors are appropriately allocated to gold?
So I'm going to stay on the topic of commodities, because when you look at the general index, and when people look at gold and they say, I'm getting an allocation because I own commodities. We just put a piece out. It's a fantastic piece. I encourage everybody to read it. Gold as a component of commodity indices ranges from 3 to 12%. We feel that's low. That's a good allocation, but not an appropriate one. Again, because of that dual nature, and again, because it's a global asset. So when you take a step back from those indices and say, yes, I have an allocation to gold, we would recommend looking at gold and understanding what your portfolio objectives are, and likely going overweight gold. So it can be a component of the commodity bucket, but go overweight, or consider going overweight.
All right, let's wrap it up here with, where are you seeing flows between ETFs and other asset classes?
We're seeing flows worldwide. The ETF level of ownership for gold right now is peaking near its all-time highs. 2012 was when we saw that high. Right now, we're seeing it just below there at about 130 billion worldwide. The difference between 2012 and today is that it's a good mix between European ETFs, which have actually seen almost 50% of the flows this year, and the US, when in 2012 it was more about 2/3 in US ETFs. But lots of activity in the ETF market.
All right, thanks so much for joining us at MarketSite.
Thanks.
And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.